Hi, I'm Paige Steers. We are here at the Mortgage Bankers Association Conference giving you the insights here in San Diego. I'm with Tom Melody, and Tom, you've been talking to a lot of lenders this show. So tell us kind of what the bank's opinions are. Are they really healthy? What are the signs that we can really see a recovery in the way?
Well, you look at the banks as far as the international banks and the domestic banks. You know, you got the large banks, you got the small banks. It's really all about the banks as far as the existing debt that's in the marketplace, because you have the life insurance companies that tend to be very well off. They have not had substantial problems at all, haven't even had minimal problems. So they are continuing to expand their presence in real estate and probably increase their allocations anywhere from 25 to 50% this year. So very, very positive. On the CMBS side, obviously a lot of talk and a lot of excitement going on. You had almost no origination in 2009. You had $10 billion last year. The projection is somewhere in the $40+ billion in 2011. You know, very encouraged. It's real necessary for some of the secondary markets to continue to increase in value and in performance. As it relates to the banks, you know, a lot of outstanding debt right now with the banks, and most of those loans are going to have a hard time getting refinanced by life insurance companies or CMBS, or for that matter, the agency business. Freddie Mac, Fannie Mae, again, very little problems. You've had a lot of press about Freddie and Fannie, but that's on the single-family side of the world, not the multifamily. As it relates to the banks, I think you continue to see substantial workouts of kind of the distressed assets. You'll start seeing more investment note sales as the banks have continued to perform well. They've made a bunch of money. They can finally start taking some of the losses that they were not willing to take the last couple of years. Also, the market obviously has recovered, and so those losses are going to be substantially less than maybe what they would have been. I think the small banks are in a more difficult situation than the large banks. International money seems to be pretty well off, and we're starting to see an inflow of capital to the United States, primarily into the gateway cities, though.
Okay, so there's a lot of new health in the market, a lot of competition, conduits are coming in. So what's that doing to rates?
Obviously, rates are very, very attractive. You see a little run up in the last 30 days or so as far as where treasuries are, but you have spreads continuing to contract, and so what's happened in the market is that the reduction of the borrowing rate over the past year has increased dramatically the value of some of these assets because of cap rate compression. You have fundamentals that are not great. They're improving a little bit. Obviously, DC is kind of a head and shoulders above any other market. You have a marketplace that is not as concerned about the future of real estate as they were a year ago. So the combination of the confidence levels, the stability of the kind of the marketplace, and clearly the contraction of cap rates as a result of lower interest rates has done a wonder for the marketplace.
So we've not seen a lot of new construction, and we have a lot of capital come into the market. So will we see more risky deals happening? Are the investors and lenders
We're starting to see construction.
Okay.
And multifamily for sure. At the multifamily conference a couple of weeks ago, a lot of talk about new construction. That is something we're going to see much of in a lot of markets around the country. It's not going to be just the DC and the Houstons. It's going to be in markets where we would be very surprised to see new construction. We're seeing office construction. We need to probably have somewhere in the 50% pre-leasing, but you start to see money coming in, providing substantial capital on the right assets with the right sponsors in the right markets. So that's a real positive. And when you have that, the equity there, the banks are willing to make construction loans on those type of properties.
But so Tom, what if you're one of those people that is sitting on the outside? You're not in a core market, you're not in a key gateway city, you have some hair in your deal. Are your options even out there today?
I think it's important to try to understand what all your options are. And I think a mistake that a lot of people make is they look at just trying to sell an asset, not understanding what the other options are. And so in some of these secondary markets, when you have some issues that may be concerning, I think it's important to understand, let's take a look at the existing debt in place. Is that worth, visiting with the existing lender trying to restructure that debt? Let's understand what other debt options would be available if we wanted to go to the marketplace. both short and long-term, recourse, non-recourse. Let's understand what, maybe bringing in a new equity partner. There's a lot of equity out there looking for opportunistic transactions. Let's understand what might be available there, and then let's also understand what could we sell this asset for. And once we understand all the options, now we'll go ahead and make an informed decision on what we should do.
Okay. Well, it sounds like there's a lot of optimism here at the show, Tom. Thanks for sharing your
There
ideas.
is.
I'd like you to stay tuned. We're going to be bringing you more insights here from MBA. Stay tuned.
Thanks.